7 o'clock, so we'll go ahead and get started. I want to welcome everyone to our webinar about the upcoming market environment, your investments, and worrying less about both. My name is Cody Cox, Vice President of Cox Global Associates, and I'll be joined by Don Cox, President of Cox Global Associates, as well as Paul Knipping of Axiom. We also have Jennifer of Cox Global Associates behind the scenes. Please use the chat box there if you have any questions as we go throughout this webinar. We restrict this webinar to about 30 minutes or so. So we're going to go ahead and get started here. If for some reason your internet question does not get answered, don't worry, we'll have the record of that so we can always come back to you. As I'm sure a lot of you know, we are giving away a $100 gift card at the end of this webinar. You will need to be present though to win that webinar, so everyone stay with us here. All right, let's go ahead and get started. Don't worry, everyone. You probably won't see us here, but we're just going to have the presentation up there, and we'll be back with you all on video at the end of the presentation. All right. We are pleased to have you join us this evening. Our goal tonight is to show you that it's possible to not worry about your investment portfolio, and you too can look like this. We will start with some brief introductions about our firm and about our guest speaker. Our guest, Paul, will dive into the current market environment and potential scenarios we may face in the near future. Then Don and I will cover how we build portfolios that are designed for the long term, investing and less worry. Finally, we will wrap up with some key action items you can do to get your portfolio in better shape by year end. This webinar is brought to you by our firm, Cox Global Associates. Our firm offers more than 30 years of investment experience and was founded by my father, Don Cox. He is an active member of the community in Katy, Texas, and serves on several boards and committees.
Hello, my name is Don Cox, and we appreciate you joining in our webinar. We hope tonight you get a glimpse of how we work for our clients.
My name is Cody Cox, and I'm Vice President of Cox Global Associates with more than 7 years of experience serving individuals and corporations. Finally, we have Jennifer Schneider, who is our Executive Administrator with more than 20 years in the industry. Together, we serve our clients with the utmost care and compassion. We take pride in the fact that our clients become our friends and people who have become part of our lives for the long term. Paul Knipping is our guest speaker today to cover details about the capital markets. Paul is a portfolio manager with Axiom. Axiom is a platform we utilize to provide clients high-quality money management and access to institutional model portfolios at reasonable fees. Paul is a chartered financial analyst with more than 10 years in the industry. Without further ado, I will turn it over to Paul.
All right. So I'll just get right into it. I'm just going to take you through quickly where the markets are now, where the economy is now, and then kind of a little bit forward-looking. And I want to make sure that we sort of keep everything in perspective and understand that investments is a long-term thing, and our horizon should be further out than 1 or even 2 years. So what I have in front of us now is directly from JP Morgan. This shows us exactly where the index level is. You can see in the upper right hand side, this is where we are now. This is where we were sort of at the trough in 2008. And you can see it's a pretty sharp incline here, 333% from the bottom in 2008. So you can see a strong turnaround. The index level right now, or at least as of August 31st, is almost 3,000. You'll hear me talk a little bit about a PE ratio, and what that means is that's for people to get an idea of where the index is trading on it from a valuation perspective. It's the price divided by the earnings. So based on that, that'll tell us essentially where we're at.
Paul, can you hear me?
Yeah.
Hey, we actually can't see your slides. I'm sorry to.
Oh, you can't?
No.
Okay. How about, can you guys make me the host again, and I'll try to share again?
Okay.
Can you guys hear me?
That works, yeah. I don't think you can hear us, but.
Can you guys hear me?
Can you hear me?
Yeah, I can.
Yeah, that works. We see the slides now.
Okay, great.
Perfect.
Sorry about that.
No
Could
problem.
you guys hear my whole spiel about where the S&P is?
We could hear you, we just couldn't see the slides.
Okay, awesome. So this was the slide. Here we can see sharp incline here, 333%. This is where the index is now. This is the index value, almost 3,000. So again, going back to the PE ratio, it's price divided by the earnings. So the price is this 29 divided by the earnings of about 40 or so per quarter. So you'll hear me discuss that in just a moment. So moving on, again, going back to the PE ratio, this is the 25-year average, is about 16.22. You can see right now we're at 16.58. So we're just above the average. Definitely nothing alarming. You know, we can look back here into like, 06, we were sort of around, what would that be, 14, 15. 2000s, we got really high. So you can see from a long-term perspective, and at least from looking at things through a valuation lens, the index isn't terribly overvalued, really at all. You can see that 16.22 compared to the long-term average is 16.22 compared to where we are now is 16.58. I know you guys hear probably see a lot in the news about how we're overvalued, and it's a big bubble, and you can really see back here in the late 90s, early 2000s, that was a big bubble. But now we're right around the 25-year average. Even though we are at all-time highs with the S&P, I'm sure you see that a lot too. The reason for that is because corporate earnings are at all-time highs, and this chart kind of shows us that. This goes back to 99. You can see kind of 08, what happened in 08 when earnings went negative, and since then things have rebounded quite nicely. I like this chart here because it kind of shows us where corporate profit margins are at, 11.5, which is pretty good. It's higher than it has been in the recent history. So things looking good from a margins perspective for companies. Going into GDP, obviously you hear the discussions a lot about where GDP is. Is it at 4%? Is it at 3%? Is it at 2%? Well, right now we're at about 2.3%. The average, long-term average, is 2.7, and they're really the reason for that, or the reason that it's been such a long recovery, and I'll get into this in a moment, is because GDP has just been growing a little bit more slowly than it has coming out of earlier recessions or other recessions. Now, GDP is essentially it's gross domestic product, and what makes that up is essentially consumption. So when you go to the grocery store, you go to restaurants, you go to the baseball game, that sort of consumption really is what makes up GDP. Government spending and investment minus housing, as well as housing. So I know you hear a lot about where GDP is, and right now we're right around 2%. I'll get into the unemployment rate now. That is at all-time lows, as you can see. This chart only goes back to 1969, but you can see it's very, very, very low. The unemployment rate is in the gray, wage growth is in blue. So you can see as the unemployment rate goes up, wage growth goes down because corporations don't have to pay as much because there's a lot of unemployed people. As this drops, this will rise to meet it. Because this has risen really in the past 2 years, you've seen inflation pick up as well. This is a main driver of inflation, which is my next slide here. You can see that even though inflation has risen a little bit because of this wage growth, it's still relatively flat. It's about 1.7 to 1.8, and this is an annual. They do it monthly, but it's year over year. So June 2019, it was at 1.7. So prices were up 1.7% compared to June 2018, and it was roughly the same in July 2019. You can see the 50-year average is 4%. So inflation is relatively low. The Fed's target is 2%. Going back to what I was talking about earlier about the age of this expansion and why this has been such a long bull run. It's really this chart right here on the right that I wanted to show you. So these are, each color represents a different recession, and basically the slope of this line is how quickly we got out of that recession. It's cumulative GDP growth since the prior peak. So you can see in, what was it, second quarter of 60, you can see how quickly we got out of that recession. Let's see, first quarter of 01, you can see pretty solid rebound there. But really, since the prior peak of fourth quarter of 2007, you can see what happened here. The slope is much lower. So that expansion average that we saw was a little bit lower than the long-term average of GDP growth. And that's why this bull market has been going on for so long, 122 months. It's because we haven't really rebounded from a GDP perspective as quickly as we have in other recessions. Some would argue that's actually a good thing because the economy doesn't have an opportunity to really overheat like it does in any of these other recessions. It's kind of sort of low and strong rather than, you know, a quick flash, sort of flash in the pan rebound coming out of an economic recession. So that's why, you know, as they say, bull markets don't die of old age, and this is why we've been on such a strong bull market for such a long time. It's just the rebound hasn't been quite as sharp. So I know you hear a lot about this in the news, about the tariffs and the trade war, and up until recently, it hadn't really affected any of the hard data like GDP numbers or global trade volume. But we have started to see that trickle into trade volume as companies and CEOs and even countries spend a little bit less. Number one, because it costs a little bit more, especially when when China purchases things from the United States, or when the United States purchases things from China. But also because of the uncertainty around what global trade really looks like. And it's that uncertainty that really is what hurts global trade volume. So you can see here, what I have in the lower left-hand side here is global tariffs. This was basically color-coded. So anything in blue here was imposed in 2008. What I think is interesting is the gray is what was already in place. You can see United States here. We didn't have a whole lot of tariffs. We've always supported free trade. And then we got into a trade war with China. You can see how much we've tacked on here. And right when we did that, you can see kind of what has happened to global trade. It's just getting into the negative territory now, really for the first time since 2008. So you hear a lot about that, and it's just now sort of making its way into this hard data. Like I said before, it was more about sentiment and how CEOs were feeling and what's your outlook and that sort of thing. But now it's really starting to make its way into to the hard data. So a quick resolution to that will get things cooking again and get things back on track. Barring any resolution to that, you can expect further volatility both in the fixed income and in the equity markets. Should we see a recession? Should this sort of push us into that recession? Again, GDP growth is already low at around 2%. If global trade starts to curtail a bit, that might send us there. It should be shallow recession, but regardless, I wanted to give you an idea of generally what recessions in the past have looked like. So this chart here shows us all the drawdowns. The red line is a 20% market decline. It goes all the way back to 1947. And any sort of gray you see here is a drawdown. So, in 07, you can see obviously big drawdowns here, big drawdowns in the early 2000s, big drawdowns in 1972-ish, 1975. But what I really wanted to point out here was the average. Hopefully we can see this. I'm going to zoom in. You can see here the average S&P decline during a recession is 30%. So I think this is something to keep in mind, and now is a good time to talk to Don and talk to Cody about your asset allocation and make sure that you're not overexposed to equities and that you're in the right place should we see a recession. Now, we don't know when recessions will happen, but it's kind of just a reminder to make sure that, when markets are screaming up, everybody wants to over-allocate to equity. People forget about the risks, but keep in mind that the market does go down So just something to think about, and obviously that's why you have Don and Cody to help you through that. Going back to we can't really time recessions. I thought this was an interesting chart. This shows us the average return leading up to and following equity market peaks or recessions, essentially. 24 months prior to an equity market peak, you can see the S&P will run up 41%. 12 months prior, it's 23%. 6 months prior, and so on, it's 15%. So what I wanted to show you here is you shouldn't necessarily get out of the market or get really conservative because you're afraid of that, because you really could miss a lot of upside, and the downside really isn't as bad as the upside is good, right? So 3 months after, it's -7. Well, you made 8 on the way up. 6 months prior is 15. 6 months after is -11, right? So that trade-off is still pretty good. 12 months prior is 23% compared to 12 months after is only -14, right? So you could be giving up a lot of returns should you try to time that. It's impossible to time. Again, this is we need to take a long-term approach and have a long-term time horizon. Equity market declines are normal, and this chart kind of shows you intra-year declines versus their full-year return. So far, year-to-date, market was up about 17% going into this month, but we've already pulled back 7. So one of the years that I thought was really interesting was this year right here, 2016. You can see we pulled back 11%, but we ended up 10. Let's see, we had a year in the early 2000s that was similar. Yeah, right here. You see about 2002, we were 2003, down 14, ended up 26. So just because markets pull back doesn't necessarily mean it's going to go down like it did in 2008 or that we're in a next recession. It's all normal, it's all healthy, and nothing to necessarily worry about. Again, long-term approach is what we want here. And this is to give you an idea of why we take a long-term approach. So what this is the range of stock, bond, and blended returns over any rolling period. And so what that means is a 1-year rolling period is just every year you look at the range of returns. Every 5-year rolling means we look at 5 years, and every year we look 5 years previous. So from 2010 to 2015, and then it's 2016, we look from 2011 to 2016, right? So it's every year we take a 5-step rolling period back to get an idea of what the range of returns is. You can see here in equity is green, blue is bonds, and gray is 50-50. In any 1 year, the range for stocks is huge, -39 to all the way up 47. That's a huge range, a huge standard deviation, if you will, a huge deviation. In bonds, it's only, it's still big, but much smaller, -8 to +43. And the blended portfolio, again, it helps dampen the volatility of the portfolio. When you combine them, it's -15 to 33. So you can see here in any 1 year, that's pretty volatile. But if you sort of zoom out, and you can see here 5 years, I'll focus on the blended return here, 21 to 1. So any rolling 5-year period, you made money, which is from 1950 going back to 2008. So this includes a ton of recessions, a ton of market drawdowns. If you take a long-term approach, you'll be fine. 10-year rolling period, 2 to +16, pretty good. And again, the further out you go, the more likely you are to make money, which I think is pretty compelling. This is my last chart, and I just threw this in here just because I thought it was interesting. This kind of showcases what's called home bias. You can see that based on where you live, it has a lot to do with what sectors you're overweight in your portfolio. Even where you live, even what country you live, you can see here that from a global GDP perspective, the U.S. only makes up about 24%, but people that live in the United States have a 71% allocation to U.S. stocks, which is, they're very overweight. You can even drill further down into that and say, okay, those of us that live in America, depending on where we live, we're over or underweight certain sectors. So financials, you're going to be way overweight if you live in the Northeast, right? New York City, things like that. Technology, I live in Denver. I'm overweight technology by probably more than 10%, honestly. If you live in the Midwest, you're more likely to be overweight industrials, and if you live in the South, you're more likely to be overweight energy. And what this really does is, again, I just want to make sure that you really take a look at how you're allocated, because you could be over allocated simply because where you live. You could be over allocated to a certain sector or a certain market simply because of where you live, which I think is fascinating and something a lot of people don't realize. So thanks for letting me join you guys on your call. I'll stick around obviously for questions, but with that, I'm gonna try to give this back here to Donna Cody. Okay. All right, Donna Cody, it's all you guys.
All right. Thank you, Paul.
Sure.
Let me get back to our PowerPoint. All right. Once again, thanks, Paul. Now that we have a good idea of what is happening within the capital markets, let's talk about how we utilize that information for managing an investment portfolio. The management of our clients' portfolios run like a well-oiled machine. As a financial advisor, we operate as our client's financial team leader and see it to all aspects of portfolio management are taken care of. Let's take a closer look at how our machine works. Paul's department helps us with the right side of the machine, the economic and security analysis. This is where data is collected and analyzed on the broad economic sectors, global economic growth and politics, and company-specific revenues and news. Cox Global's team focuses on the left side of the machine. Strategy allocation and portfolio monitoring. We look to see what type of strategies will work best together to help a client achieve their goal within their personal situation. We monitor portfolio performance and analyze how changes to a portfolio will impact its results in both the short and long term. We also help you make decisions regarding cash flows in and out of the portfolio and process transactions as needed. This process is ongoing. It happens during times of change and even during times of uneventful news. Especially during a changing market environment, it's important to have a team thinking together to problem solve, rather than someone trying to go at it alone. We have found this works best for our clients. Once again, I'll just remind everybody listening, if you have any questions, please put them in the chat box there. Let's dig a little deeper into some of the types of investment strategies we like and why. Let's first begin with sector rotation. Sector rotation is a strategy that uses mathematical models to determine when a sector is rotating into and out of favor with the current market environment. The strategy we like will invest in only the top 4 market sectors at a time. Next, we like to utilize a low volatility strategy. This strategy that focuses on holding positions that have historically had and are believed to offer a risk level lower than that of its peers and general market. The strategy we like to consider for our clients will have a low volatility focus that includes a rising dividend as well. A rising dividend is a signal of company strength. If we can increase the income potential in a market period where we may experience some negative returns, the total portfolio return can benefit. Total portfolio return includes income or dividends and gains. Finally, we want to mention a risk-managed strategy. Risk-managed strategies aim to achieve consistent long-term returns while minimizing the downside risk of the equity markets. The strategy we like uses ETFs designed for long-term returns, downside protection of assets during major market downturns, and is hedged using put options. It is common for us to utilize more than one strategy within a portfolio. When we combine strategies based on the following criteria. Correlation of assets. How likely are 2 asset classes going to move together? This graph shows you how likely these asset classes will move similar to the S&P 500. If they perform like the S&P 500, the bar will read 1%. If they do not perform like the S&P 500, the bar will be closer to or less than 0%. We will review statistics like these when we build portfolios. We also look at the likelihood of achieving a targeted return with the proposed asset mix. We do this by studying past returns of that mix. The likelihood the proposed asset mix will stay within a defined risk statistic, and when needed, the likelihood a proposed asset mix will meet the income needs of a client are also taken into consideration. Now, let me pass it over to Don.
Our approach, investment approach, is followed because of you. You're the reason we do things the way we do. With over 35 years in the markets, we know that economic cycles will continue to come and go and that the market will go through ups and downs. We are believers in long-term growth, as Paul pointed out earlier, and we believe it is the strategy that makes our clients worry the least. We continuously look for strategies that fit well into our approach. Some of the strategies we mentioned today will be used, and sometimes we consider a different approach when we have a client whose goals are a bit more aggressive. Selecting the right investment strategy and ongoing monitoring of your portfolio is what helps reduce worry. We encourage all of our clients to meet with us on a regular basis, at least once a year. We want you to understand your portfolio and why it is designed the way it is. With that understanding, you will have realistic expectations for your results. Here's an example of what happens when you work with an advisor. A Vanguard study indicated that investors who worked with an investment advisor averaged a 3% return per year greater than if they managed their assets by themselves. You see how the worry-free process we follow takes multiple people to run well.
Thanks, Don. We've told you how we do things, but we want you to be able to walk away from this webinar truly feeling less worried. Here are some action items you can get started on right away. Start with a look at your employer's retirement plan account. Then look at your IRAs, Roth IRAs, and any taxable accounts you own. Remember information provided by Paul. Think about the next 6 months. You know that stocks and bonds move differently during periods of market change. Apply that to your account. Ask yourself these questions and adjust accordingly. Am I investing in all the same types of stocks? For example, U.S. large companies? Do I have a good mix of stocks and bonds? Do I have some international stocks or bonds? Is any single stock position taking up most of my account value? What are the fees for my account, trades, and any advice I receive? Can I increase my contributions to this account? And if so, why haven't I? Will I face a large capital gain in 2019? Are there any losses I can take to offset large gains for the year? Am I comfortable with the risk of my investments as a whole? Know when you need help and when you should. I've got one more there. Do I understand all my investments? All right, so know when you need help and when you should make adjustments to your account. If you are worried and unhappy, consider a change. Consider talking to your financial professional more. Reach out from time to time and let them know what you are thinking. As a financial advisor, we want to be there for our clients as much as possible. That is our presentation for this evening. Are there any questions we can answer at this time? We have about 5 minutes left. And I'll remind everybody, if you have a question, please put it there in the chat. We'll wait here a couple minutes just in case. Nothing? Okay. Well, and keep in mind, too, if there's a question that comes in later, we can always reach back out to you. I think we've got all your names and emails. But once again, like I mentioned at the beginning of the webinar, participating in our webinar, we did want to give away a $100 Visa gift card to one lucky winner. So I'm actually going to have Dawn here go ahead and draw out of the names of people here.
And the winner is Steve Mims.
All right. Congratulations, Steve.
Can you hear that?
Start this video here.
All
Can they
right.
see us now? Yeah. Okay. Well, congratulations, Steve. All right, there's his name. All right. I want to thank everybody for joining us this evening. We are here if you have any questions at all. Please feel free to call or email us. You're also welcome to set up a phone or office appointment by using the Calendly link shown here to learn more about us or our portfolios. So with that, once again, appreciate everybody for coming. Hope everybody have a great night.
Thank you for joining in. We'll plan another one in 2 or 3 months from now. We like to keep our clients informed. We've learned that that's the best way that you understand what you're invested in. So appreciate everybody's help, and we'll see you on the next call.
All right. Thanks, everybody.